Okay, guys, good afternoon. Christmas came early this May. So that's how you should feel, just like a Christmas when you're catching knives. It's May 7, 2021. I'm Nikki Yu, your host for Awesome10X YouTube channel, and thank you for watching the Free Friday class. Simply put, risk is actually low when risk aversion and risk consciousness are high. And it's actually highly risky when they are very low. That's actually a tweet by Mr. Howard Marks, the CEO of Oak Tree Capital Management, a successful investor. He is actually one of the greatest value investors of all time. Now, my view is that trying to catch a falling knife is not always a mistake. When you hear traders talk about don't catch a falling knife, the first reaction is that when the stock markets are declining, you actually are catching falling knives. True or false? We will actually demystify this falling knives theory. Trying to catch a falling knife is not always a mistake. Good stocks often do suffer big and unexpected drops. The problem may be your size. You could be oversized. You are probably buying a lot than you can handle. But if you take advantage in small bites, you can actually handle those reds. Hashtag Awesome10X. Overpriced is also not the same as going down tomorrow. The reason why overpriced can remain overpriced is because it doesn't exactly go down tomorrow. A stock can remain overpriced for a year, for 2 years. So when it falls, it's actually just fixing the overvaluation that could be happening for the last 6 months or the last 2 years. So you have to understand that when you find an overvalued company, it does not necessarily mean that it should be shorted or that it should fall. But the main risk is actually permanent loss. The most dangerous thing is to buy something at the peak of its popularity. And at that point, all favorable facts and opinions are already factored into its price, and no new buyers are left to emerge. Reopening, closing, COVID recovery, cryptocurrencies. When it is something at the peak of its popularity, all the favorable facts are already priced in. There is a cyclicality about that nature of the aspect, and no matter how good the fundamentals of the companies are, the main risk is the permanent loss. He talks about buying in times of upsets. Let's watch this 3 minutes. What does Howard Marks think about falling knives?
So value investors, including yourself, talk about the importance of margin of safety in our investments. But as Wilbur Ross puts it, distressed investors oftentimes find ourselves running into burning buildings. So in distressed situations where prices are falling, and you oftentimes feel you're catching a falling knife, how do you get yourself comfortable about your investments, and how do you think about your margin of safety? Thank you.
Thanks, Jeff.
You know, there's only one intelligent form of investing, and that's to figure out what something's worth and try to buy it for less. Distressed debt investing is not different in that regard. We have to do the same thing. And so, you know, simply put, you know, I'll exaggerate the simplicity, but you look at a company, you look at the business, you figure out what it could make in a normal environment, and you figure out what that company would be worth, generally thinking about to a buyer, to a strategic buyer, once its problems are largely resolved and once the capitalization has been restructured. Then you think about how that value will be divided up among the various classes of claimants, and you figure out what a piece of a claim is worth, and you see if you can buy it for less. So, and if you can make those judgments on the basis of conservative assumptions and still end up with good room for profit, then that's a source of margin for error. I mean, I think that the margin for error comes primarily from being able to use conservative assumptions and then still be looking at a generous rate of return, you know? Now, it's very, but before I stop, I must say that it's not true that the more conservative, the better, because you can get to the point where you can make assumptions that are so conservative that you'll never lose money, but it will give you a target buying price, which is so low that you'll never buy anything. So you have to, you have to kind of gut it out and be willing to include some optimism, or else you may never get to buy anything. Now you mentioned catching falling knives, and my vision is that when the stuff hits the fan and there's blood in the streets, most people go like this, and they say, "Well, we're not going to buy until the knife stops falling, until the dust settles, until all the uncertainty has been resolved." The trouble is that once that happens, then the price will have rebounded. So we want to buy at a time of upset, and while the knife is still falling. And I think I think that the refusal to catch a falling knife is a rationalization for inaction. It's our job to catch falling knives. That's how you get bargains, but you have to do it carefully.
Thank you.
So I told you, it's our job to actually catch falling knives. What you have to understand, I'll highlight a few things he said. Figure out what something is worth, buy it for less. Use conservative assumptions on how much that business makes in a normal environment. Figure out what that company will be worth for a strategic buyer if you're going to sell it. Once the problems are largely resolved over time, once capitalization is restructured, think about how that value will be unlocked and divided. And on the basis of that conservative assumption, leave yourself a margin of error. He made an excellent point. You cannot be so bearish in your conservative assumption. You have to also have an optimism, like a bearish case, a base case, and a bullish case, and how much that company is worth, and you should be making money. Do that over a series of stocks and or companies or cryptocurrencies, whatsoever you're doing. And you should be able to come out with good risk-reward ratios, nothing different from what traders are actually doing, looking for ideal setups. And in this case, for an Awesome10X investor, find attractive low downside, but very high reward, very high upside investments. So let's take a look. This is actually a good video. Try to watch this one. Howard Marks on risk, market cycles, and investing. Follow Street Fence, few subscribers, but look for this title, Howard Marks on risk, market cycles, and investing, presented by the Amador Valley Investment Club. I will actually take a few things that he shared in this class. Some of my favorite quotes from Howard Marks is the desire for more, the fear of missing out, the tendency to compare against others, the herd, the influence of the crowd, and the dream of the sure thing. These factors are near universal. Thus, they have a profound collective impact on most investors and most markets. This is especially true at market extremes. The result is mistakes, frequent, widespread, recurring, expensive mistakes. You've heard the saying, when everyone is quacking, sell the duck. When the ducks are quacking, feed the ducks. When everyone's yakking about something as a great investment, fear that name. The desire for more is gonna lose money. People who chase usually lose. Several things go together for those who view the world as an uncertain place. Healthy respect for risk, an awareness that we don't know what the future holds, an understanding that the best we can do is view the future as a probability distribution and invest accordingly. Insistence on defensive investing and emphasis on avoiding pitfalls. To me, that is what thoughtful investing is all about. If you're aware that the market is stoppish, just like what we felt, December, January, February, we're selling companies because pigs get slaughtered. March, April, May, you see stocks dropping. Even if this looks like a catch a falling knife, I'll argue that the downside is actually not as high as you may deem. And what Mark Yusko said, the greatest wealth is created by being an early investor in innovation. Making that investment requires believing in something before the majority of people understand it. In a way, you have to be a contrarian. When people are exiting the markets, you will be mocked, ridiculed, and criticized for your non-consensus action. Everyone is afraid of growth stocks. It's absolutely worth it. We want to buy growth stocks at a reasonable price, and I'm going to share to you how reasonably priced they are right now. Howard Marks discussed 24 types of risk. The first risk that you should avoid, which Warren Buffett said, is losing money, permanent loss. You could have a loss of volatility. You could fall short, not having the necessary means for a payout or an income to live on. Let's say you wanted to earn 8%, but you just made 5% a year. In the last 10 years, you fell short. Another risk is missing opportunities. When you see a falling knife, people who actually wait for the dust to settle down, I heard this in 2020, I'm going to wait for the recovery before I actually buy into the companies. From March, April, May, the market was going up, even if there was no resolution. A lot of companies were still losing money, even until now. Even if your airlines have doubled, tripled, they're not really exactly improving. Missing opportunities is not taking enough risk. The FOMO is to jump on the bandwagon of risky investments for fear of living with envy. Ask yourself, how many of your friends are bragging about their 10x, 20x, 30x, 40x, 50x in a quarter or so? That fear of missing out is actually a risk. Credit is the risk that a borrower will be unable to pay interest and repay principal as scheduled. In case you can't pay your interest, that is a credit risk. Illiquidity is when you buy a stock, but there is no buyer. This is why OTC-related names or pink sheet names or penny stocks have an inability to sell at a good price when you need the money. Liquidity is less. Concentration, the risk of not being diversified when sectors drop in value, assuming your entire component in your companies are mostly expensive SPACs, highly concentrated, you get what you deserve. Highly concentrated on certain healthcare sectors, genomics, a high-risk early startup phase, you get that risk when the sector drops in value. Leverage is a risk. Losses are magnified when investments decline in value by using borrowed money. No matter if the interest rates are so low, if the stocks or whatever you are buying is going down, your losses are doubled or tripled or 25% higher. Funding, the need to make a capital call when a loan comes due. Think about the Archegos Fund. Archegos Fund actually failed to actually meet those leverage and funding requirements, thus margin call. Manager, in case you're not choosing for the stocks, you're finding an ARC ETF, an exchange-traded fund. The risk of picking the wrong manager, or in case of a stock, the risk of choosing the wrong founder, the wrong CEO, and that sort of thing. This is also a risk. You have so many stocks, you are over-diversified. The standards of inclusion may drop, your filter screen may drop when you're not actually choosing with the appropriate attention to that company, leading to a potential lower risk-adjusted return. Volatility, that's a risk that is the price of admission in every Awesome10X pick. This introduces the emotional component that may result in a permanent loss from selling too soon. Another risk, basis. This applies to arbitrage when you are going long a stock and short another based on the one being cheaper than the other and common patterns repeating themselves, and yet something goes awry when the relationship breaks. There are people actually go long when the sector is cheaper. Oh, this is a 5 times multiple against this 10, 20 times multiple, not realizing the entire sector is actually weak. Model. This is an excessive belief in a model's efficacy leading to excessive risk-taking. You actually believe that your system is doing so well, and so you have an excessive risk-taking efforts undermining your risk. So you wanted to have 150% exposure or so. The black swan is simply a risk that Everything is still undetermined and uncertain. Therefore, something that hasn't happened doesn't mean it would not happen. This is the statistically inconceivable event that actually materializes every once in a quarter, once in a year. An earnings is bad, a news disclosure, an acquisition, or something. Career. Your rewards are shared asymmetrically, then it may not be in a money manager's best interest to take risks where there could be short-term pain. A lot of fund managers actually have a um, short-term time frame because they fear losing their clients. This is something that Awesome10X is happy to share, that we are not actually pressured by any fund management career. We can actually lose 20% in a quarter. We're not going to lose our clients or our jobs. We actually manage our own. Headline is a risk. This is when losses are big enough that they can potentially generate media attention. Take note, because of that career risk, people are actually most of the time going into momentum on the upside, chasing whatever is hot, momentum on the downside, selling whatever is low, even if it could be actually valuable, in which case we are doing our falling knife strategy to buy those names while they're being sold like the baby on the bathwater. Headline risk is when losses are big enough that they can potentially generate media attention, something that Melvin Capital had a headline risk about in their GME. Event, this application to bondholders when equity owners are leveraging up the company, putting the bonds at more risk. We actually don't use that so much because we don't really have bonds in our portfolio. Other risks, fundamental. There is a real asset underperforming in the real world. That is the biggest risk, that the business model is wrong. Valuation, this is something you could avoid, overpaying for an investment, paying double or triple what it should be, just your margin of safety. Correlation, being less diversified than expected. This is a risk when you are unfortunately in one sector. Let's say you're all in renewable energy and solar, and everything goes down, much to the surprise of an investor. Similar to what happened with edge computing, Fastly fell and then Cloudflare followed. Interest rate risk is something that you can't control, but is actually Janet Yellen's call. The risk that higher rates can lower the value of all securities and other yield-oriented investments, bonds, stocks, everything. Purchasing power, the risk that cash received in the future will just be eroded in value due to inflation, hyperinflation. And upside, the risk of being underexposed to a very good financial event occurring in the future. If you are bearish so much, you're actually losing the risk of the upside because you are thinking too much in the bearish case. So those are the 24 risks, and take note what's happening. What are the risks that people are undermining and overvaluing today? Right now, we are actually in a flash sale, a Christmas sale this May, up to 80% off. And I took a look at how big the discrepancy is. You can save up to 80% off on these assets. These assets are nowhere in the realm of going to zero, for a permanent loss of going to zero, but some of them are actually going down 80% from its peak. They are the following companies: Peloton, owing to the Tread Plus headwind; Affirm, the affiliation with Peloton on that said Tread Plus and refunds happening to their treadmill, notwithstanding the fact that Peloton bikes are still growing and the subscription as a service is still growing recurring wise. So if there's an 80% discount, we should actually take a look into that opportunity, a high growth stock that we could possibly get at a very good discount. Affirm, Lemonade, C3AI, Yatsen Global, Ehang, Lucid Motors, RC Moto, Fastly. Just recently, Fastly had a bad quarter. For others, it might be a black swan, but for others, the digital infrastructure is yet to be known for the next 5 to 10 years. And therefore, that discount of about 70% is something that we Awesome10X investors would like to own if we don't have it in our portfolio. So a lot of us are actually looking to buy most of these companies this month of May. Lucid Motors, RC Moto, Fastly, Palantir, Dada, Zoom Video, Agora, Xpeng, SunPower, Array Technologies, NanoX, X-Ray Reimagined, Unity, CD Projekt, Doyu, Desktop Metal, Nano Dimension, Copen, Teledoc, Amwell, Rewalk Robotics, Bio Nanogenomics, Sundial, Asensa Surgical, American Battery Metals, Humble Pay, Agrify, Dermtech, Immersion, Saragon, Global Stars, Spotify, Pinterest, Baidu, Alibaba, and Twitter. These are just some companies that I deemed irresponsibly or unwarrantedly sold. They could continue to fall down. And I'm going to show you the charts first. And then we're going to go to the Excel file. Actually, let's start with the Excel file before going to the charts. So this is something that I hope you could see. Wait up. I'm going to zoom in. Data. How do I zoom this? Wait. View, zoom. Okay. So what I did was categorize. You could see that in the remote work sector, your favorite crowd favorites, Peloton and Zoom Video, had an epic rally. You could see that that epic rally was actually now dropping 50%. You get a 50% discount on both of them. Last price, 170. Oh, sorry, I'm going to share that Excel file. I'm going to share it now. Wait up, new share. Can you see my Excel now? Is it seen? Can you see now? Okay, so I'm gonna share this. Okay, all right, guys. So I made an Excel file and I also posted the current price, the 52-week high price. This is the 52-week high, and the current market cap in billions of dollars. So in the realm of these two, remote work and Zoom Video are considered sort of, if we are talking about the Pokemon, we said about the Charmander, the Charmeleon, and the Charizard. If you fall in the 20 to 100 billion category, you're in the mid-cap zone. You're in the Charmeleon zone. So a 50% drop on Peloton and Zoom Video could fall 60% or 70%. But we would argue that these levels today are actually attractive enough. Meaning, with the bad news, I would argue, all right, let's say the 52-week high. So I'll do this. Let's make a 75% discount here from its 52-week high. So we're going to pay just 0.25. So you do that all over, and you'll have your range of potential entries. We like to own companies. Don't worry, I will share the Excel to all the inner circle members. No worries. You could see that I tabulated per category the companies that I believe fundamentally they have a good founder. I believe in the recovery. The recovery will happen not necessarily in 3 to 6 months, but actually the next 6 months from today is an opportunity. If you have cash, you want to be deploying while everyone is leaving as if there's fire in the building. So if you did this, will you actually make, oh, sorry. Yeah, I said I made a, no, I meant it. I meant a 75% discount from the peak. So 25% of 171. So I'm willing to pay $42 if that ever reaches. Yeah. Okay. So this is the current price. It's now doing 51% down. If the market will continually sell these off, it means that your 83 could go 42, your 293 could go 147. Whether that happens or not, the probability in my view is actually very little. Because for Peloton, you have the refunds. It could happen in the next 3 months. But if that were to happen, that would be a great buying opportunity. We saw this happen before. I'll tell you an insight There was a company before that actually had a problem. That company is Chipotle. Chipotle actually had clients actually getting food poisoning in the E. coli incident in their food. It took them about 2 years for a lot of marketing efforts to actually prepare people to come back. There was a loss of sales, something that Peloton will eventually get in the next 6 months. But we believe, just like the overestimation of people or the aggressive discounting that people will expect in this potential refunds of Peloton, any drops is actually going to give you a potential move about 3x or 4x. If you're able, guys, to buy a company that is down 75%, you automatically can make a 3x or 4x in the next 3 years when the company will recover. And why would it recover? Secular trends are intact. I do believe that the Peloton bike, the users, are very much still going to be there even with the refunds on the Tread Plus. So you read up on the next 6 months how John Foley will actually prepare the recovery rate. And that means that any drops, the 50%, well, it can fall to about 75% discount is actually more of an opportunity. So this Excel is just to give you a guide. Zoom video is 290. A lot of people would argue it's never going to go 140. And you could be right. Because even if everyone says that $86 billion is overpriced, indeed, it used to trade even as high as $150 billion. Because of the fact that everyone and every neighbor, no matter the reopening, is still using Zoom video because of how efficient it is, whether it's online school, whether me talking to several people with different countries, different geographies, Manila, Luzon, Visayas, Mindanao, somewhere in Canada, somewhere in America, whoever you are, streaming is a secular trend. Remote work conferencing is a secular trend, whether you are in the office or out of the office. Paying $86 billion market cap for Zoom when it makes $6 to $10 billion of sales and a lot of earnings, because this is software as a service business, means that you're actually buying a cash flow machine. Something that is great, not necessarily today or tomorrow, but actually any drops is just a great opportunity to load up. Now, let me tell you a small company. When you're looking at a $6.5 billion, what are you saying? That's a small cap. A small cap is a Charmander. Yatsen Global is an IPO. I call it a direct to consumer and an e-commerce. It's an e-commerce play in China. It's a makeup brand that is trying to be the L'Oreal of the digital age of China. So far, if you take a look at the sales, you're betting on the founders able to monetize on this impulsive trend with women and men wanting to be beautiful. Take note, the secular trend here is vanity, being more beautiful, whether that be the Estee Lauder or in this case, Yatsen Holdings Perfect Diary, that's their makeup brand, is the sellable product here. So in my view, after a drop, take note, the 52-week high was $25. Today, you can buy it at $9.78. All of these last prices are as of May 6th, last night. So today, it's whopping 60% discount. Take note too, that we were buying before because the IPO was $10. So I would argue that the current levels of 9 all the way to 6 is really an opportunity to buy. So of course, when you are buying closer to that 75% discount, it makes it cheaper. Meaning the discount here of negative 61, so less downside. Even if you're buying, let's say at 9 to 6 or 10 to 6, it's lower. So that's, let me put another column here. If this were to happen, this 50% discount, how much more would that be? Let's just put it here. Another 48% drop, another 50% drop, another 34% drop, and so forth. We have to be conservative with our assumptions, but obviously, I'm trying to make a very, very dire prediction. Now, let's note the following things. Why a fire type Pokemon? Oh, sorry. I just like Charmanders and Pikachus. But of course, we can use Bulbasaur, Squirtle, if that's like your fave. No problem with the Pokemons. It's okay. Okay, so with Alibaba, and okay, so let's discuss about EHang, eVTOL. It is a $1 billion market cap, very small. Very small, such that the market sold it down 81%. So assuming that you do believe that EHang is undervalued, you would argue to buy it at 75% discount or about $32. But the current price is actually $23, suggesting actually very little downside. That is, of course, if you believe in eVTOLs, electric vehicle takeoff landing. Why do we believe in EHang? Number one, it is actually the cheapest eVTOL, despite the fact that it is commercially available today, and others will have 2024. So they already have FAA flights, and they're expected to grow times 4 in terms of their sales because they already have contracts with Alibaba, contracts with China, and contracts with UPS. So with so many delivery and logistics expected to happen via eVTOLs, drones and passenger urban air mobility, as well as medical supplies, I say that at $1 billion, this is actually an amazing value. So of course, everything is the eye of the beholder. Okay, let's take a look at Alibaba. This one is actually in renminbi. I think that's why 4.7, you have to divide this by about approximately 7. I think that's the renminbi, dollar yuan. But it's about $674 billion. It's less than $1 trillion. And although Alibaba has only fallen 30% from its high of 319, I don't know if you can actually buy Alibaba at $80. I think that is an amazing impossibility. So for Alibaba, this is actually just a very rhetorical 75% discount. Let's assume that you do want to buy it at 226 and it actually falls. How much lower does it fall? It doesn't really matter about how the knife is falling as long as you have a plan. You have to ask yourself, if Alibaba's cloud computing is growing fourfold, e-commerce in Southeast Asia is growing from 1% penetration rate to a potential 10% of which Alibaba has. Cloud computing is a 70 to 80% cloud high margin business, notwithstanding how great Alibaba's existing investments already are in China, whether it's Alipay and financial, of course, that's the crown jewel. People are actually arguing that Alibaba right now, and I would argue the same way, just like Alibaba, one of the largest position in Charlie Munger's portfolio, about 19% of his wealth is actually in Alibaba. I agree, and Awesome10X agrees, Alibaba is a big tech that's actually being sold unwarrantedly. So it's actually in a ×3 trajectory. And this drop, 30% down could fall 50% down, 300 could go 150 or 160. But that is what? A great opportunity for you to load a lot. As long as it falls, keep on buying. As long as you have cash. Now, if you don't have cash, we argue to save up, save a lot of money so that if you have money, you deposit in your interactive brokers and take advantage of this Christmas sale. Whether this Christmas sale in May can persist in June and July is your opportunity, not your problem. It is really a great opportunity to load up. Baidu is already down 45% from its peak. 354, it's now $192. And if it actually goes down, I argue it's not going to go 75% down. Baba and Baidu are actually part of the sector big tech. For big tech, my historical analysis in all of them is that you can actually, I think this market cap could be wrong because I think Baidu, actually I'm not sure if is it really $68 billion market cap? Or it's not 10 billion, definitely. But either way, people are betting on Baidu, not in the digital advertising. Yes, Baidu is known as the Google of China, but it's far more than that. Baidu has their own self-driving taxis not a proxy, not a concept, not just a proof of concept, but actually already running in the streets of all the Beijing. So it's actually one of the first, aside from BYD Electric, to do robo-taxis already in China. With robo-taxis growing in the next 5 to 10 years, you want to actually increase your positions on Baidu. The play on Baidu is artificial intelligence, automation, and robo-taxi. That is something that Baidu has. And all those cars are all running with the Baidu artificial intelligence. They did not have to buy it from NVIDIA. They have it from their own. Fastly is probably amazing. In fact, notice this. The lower the market cap at $4.8 billion, the more likely that people would sell it down for fear that it has no track record. It's too new. It's too new. They are fearful of that. And just like Mark Yusko said, he was an early investor of Bitcoin. In order to make those 10x rewards, you have to actually be willing to buy these $1 billion companies, even at the risk of being ridiculed, said as an asshole, and whatsoever bad remarks. Fastly is something that everyone is already selling off. And right now, at $42, while it is already down 70%, it could fall further to $34. That said, at $34, if you want a 75% discount, you're just looking at a potential 20% drop. And I'd say that is an opportunity, if you ask me, because edge compute is not something that Akamai, Limelight Networks, or Cloudflare can handle by themselves. You want fast in your mobile, the loads, fast loading times. You want streaming action, Fastly does that. So whether you're looking and browsing your Shopify in your mobile phone, ask yourself how all those game streaming will happen without edge compute. The answer is not going to happen. Digital infrastructure, it is a core holding. Fastly would be an attractive buy. I'm actually happy that because I only had about 33 stocks in my portfolio and I have some 50% cash, I could actually, 33%, but I could actually load up more cash. I'm actually looking to buy some Fastly on the way down. I see an opportunity on this 80% and 70% drops. American Battery Metal has dropped about 70%. I think a couple of days ago, it actually dropped more than that. It even fell $1. So when it fell 90 cents, I think some of you guys bought $1 or $1.20. Take note, American Battery Metals is seen as a pink sheep. That's why it's still a Charmander. So it's very small. It's like $800 million market cap, disrupting the entire electric vehicles in terms of battery recycling. So with SPACs trading at $1 billion, $2 billion, $3 billion, I'd argue that American Battery Metals, while it is too early because they are still doing their factories, this May is breaking ground. Give them about 6 months. They're actually gonna already recycle. It's actually gonna grow from 140 or 120 to as much as $2 to $3. I believe, by the way, that all these 52-week highs are gonna be broken to all-time highs. Give it about either 1 year, 2 years, 3 years. All depends on how strong the personal company itself is gonna grow in their own milestones. Meaning for Peloton, the catalyst is how much can they actually show to the market how little the refunds are on Tread Plus and how much more recurring the revenues are from their existing business without Tread Plus. Notice when Peloton had an IPO, none of the Tread Plus even existed. It is just an ancillary increase of income, not necessarily their core holdings. Similarly, Zoom Video, while it's being sold right now, could actually surprise on the upside. What is that imagined upside? It comes from the fact that no matter the reopening story, when Zoom Video shows the entire 6 months results and the next 6 months, that everyone is still subscribing to Zoom Video, just like how recurring the Netflix subscriptions are, or how recurring the gaming sector are, just like what was evident in Activision. That's when you'll know that this was never a remote work play. It was a secular, sectoral, just like how you perceive Microsoft. It doesn't happen because of before pandemic or after pandemic. It's just a staple. And that's what Zoom video is for a majority of people. So that is really why it will sustain that high market cap, because who doesn't want a high cash flow, high growth, 80% SaaS, and what's more, what a credible CEO, something that is very hard to find in this world. SunPower is just a $3.88 billion company, a $4 billion company. It's the fifth largest, I think, the number one being Next Era Energy when it comes to solar. Last year, SunPower divested, or rather split. So if you had SunPower shares, you got free Maction shares. They wanted the SunPower to be residential installation and the hardware part, which was really the cost of the panels, to be handled by Maction. In certain, in just a few sentences, SunPower and Sunrun, both of them have fallen 60% and 53%, primarily because everyone was so hyped up with the Biden administration's trillions of dollars investment into renewable energy. SunPower, Sunrun, Next Era Energy becoming some of the easy beneficiaries. Now, that easy money right now could be gone, but has it been priced in? It is. With a 60% drop here at $22.46, notice that even if a 75% drop were to occur, you just have to prepare yourself for this 22 to 15 drop, or a 46 to 25 drop on Sunrun, and you can actually see yourself actually marking from 14 to 57 at times 4 move. When you're buying a stock at 75% discount, a majority of your returns will just come from 25% to 100% or times 4. You'll make a 4x just by the fact that you made a huge margin of safety when you entered the stock. So making a 400% return might not sound appetizing in 3 years, or it is, because 4x is 4x. It all depends on your quality of sleep. I'd rather diversify in a secular trend that I feel is inevitable. It's an inevitable secular trend, and SunPower and Sunrun and Array, by the way, Array is also dropping 53%. This is also a Howard Marks IPO. From 54 high, Array is now $25. So at $3 billion, take note that these solar power related names are actually very, very cheap compared to their 10-year growth plans. SunPower being the majority of all the Californian homes, 50% of all residential, is already cornered as a client of SunPower. And with more homes being built in the next decade, I'd say that those homes are all gonna be built with SunPower. Sunrun and Vivint Solar had a merger last year, which everyone rejoiced about. And I'd say that if ever this drops back to $25, it's a reset on that area that's actually going to give you just more upside. It's not just a 50% upside. That 4x upside can happen with or without monetary easing or Fed easing. This is a company-specific reason to own. Same thing with Array Technologies, because when you are investing $2 trillion into the sector, solar trackers are higher yields, or definitely it makes the sunlight store more electricity. Therefore, all of these solar companies, whether it be First Solar, Canadian Solar, all of them, I just didn't post it here, are actually beneficiary, and a 50%, 60% decline is more of an opportunity for you to load up. None of these $349 billion is actually representative of a high penetration rate that they will surge in the next 4 to 5 years, simply because of the entire electric vehicle revolution. And the climate change, of course, the carbon neutral, that is an ESG climate change pledge of all the countries, especially US, China, and Europe. Now, Agora is well known because of Clubhouse. But what you don't know is that Agora powers up everything when it comes to gaming, and gaming being the first one to adopt all these live streaming action. Whether you're actually playing or talking to your friends in Discord or in Unity games, any mobile game handling live streaming is Agora. And for $4.85 billion, And its business is all in the realm of streaming, as in live streaming. When you see the secular trend here, you're only gonna whet your appetite for another 3 to 5x, maybe not in 10 years. That could happen in just 2 to 3 years. So look at the upside, because while the downside is 30%, it's actually worth it. What's a 30% drawdown for a 200 to 300% upside move? So that's really something that you have to concern yourself about. Is DQ a good raw material play for solar plays? Oh, unfortunately, I wasn't able to study DQ, so I don't know how to answer that. Okay, in terms of fintech, we have some great opportunities here. Affirm and Lemonade are now dropping 60% from its peak. Affirm from 146 is now 54. If this continues to drop 75% down, 36. Why did I choose 75%? Because I think that most of these companies actually needs a bad news only to make it go down 75%. Without any bad news, I don't think it's going to go fall down like that. Affirm's numbers is actually very good. Reopening schedule. It's actually a company that is actually, I think, getting drops because of their affiliation with Peloton. But what people are undermining is Affirm is affiliated with Shopify. Affirm is affiliated with Walmart, with Nike, with Expedia, with Airbnb, with all these reopening wedding themes. Buy now, pay later, I believe, is a secular trend. It's really better and an honest, transparent product, right, rather than the credit cards. And with that disruptor at just $14 billion market cap and Lemonade at a whopping $5 billion market cap, these are just an amazing opportunity to simply buy some fintech movers that's perhaps going to be 5x or 4x at the very least. So take note at what you are actually looking at. We are looking at this from a margin of safety perspective, like a Howard Marks will. And it's just really upside all from here. What's a 30% downside? It's nothing when you consider 300%, 400% upside. The risk reward is 1:10. The volatility is just the price to pay for an awesome 10x great reward when you do retire in the next 10 years. XPeng, wonderful reset. XPeng right now is trading at $26. It has already fallen 64% from its peak of $75. You might ask yourself, what did XPeng even rise to about 50 billion? Right now, it's 21 billion. At some point in time, it was triple that, even as high as 50 to 60 billion. The reason because XPeng was doing great numbers and had been showing their Tesla Model 3 version or a cheaper XPEV sedan. That's their P7. So with more models and really giving Chinese and Europeans, offering them a lot of alternatives, with so much competition, people are saying they don't know the winners. But I'd argue with XPeng management and Lucid Motors, they're able to execute. Note that I also like NIO. I just didn't put it here because it's not 70% down. Nonetheless, with 70% down already on XPeng and Lucid Motors, these are really appetizing opportunities, if you're going to ask me, because long-term electric vehicles is a ×4 sector. So you already know that just like the smartphone era, everyone had to go from landline to mobile phone, from fixed line to mobile phone. What we are firmly of conviction belief is all those gasoline cars are internal combustion engine will go become EV. We transition from the horse carriage to gasoline-fired cars, and from gasoline-fired cars, we're going to go electric. Therefore, that electric vehicle would be having some great winners, and at $20 billion each for XPeng Motors and Lucid Motors. These are actually some amazing values for a company with great upside. If we are in the private equity version now, this is really something that I'll hold 5 to 6 years for. I think the transition will happen 2025 to 2026. And so it goes to show you that Tesla is, of course, going to have their big move in 2025 to 2026. People paid a lot today for that big move, but it's because it's very predictable that Tesla's going to win the race. Okay? But it's not going to leave everyone else behind. I do think that just like the Apple iPhone had Huawei, Oppo, Vivo, so many smartphones in the world, You'll have Chinese cars and Lucid Motors for the Mercedes, the luxury brand. There is a sector for them. This is an amazing thing, guys. Palantir is so cheap right now compared to what it is doing, not just for government agencies, but also for even the likes of Hershey's and Walmart, even for medical healthcare. They're working with Schrodinger, which is actually helping detect cancer and drug discovery. People are asking, what is more favorable to catch? Is it Etsy or C Limited? Unfortunately, C Limited is not cheap right now. Etsy just fell. Actually, from 225, it's now $150. You could probably get Etsy at about $100. I wouldn't buy yet at 150, but at 100, yes. So I'll just wait for those two. For e-commerce, not yet for those two. I'm showing to you like really low downside. So I'm taking a look at certain names. Palantir has already dropped from a high of $45 to $20. Granted, it could fall down. People might argue it's going to go 11, but I argue it's very difficult for it to go down. Earnings will come May 16. Watch out for Palantir's results. I'd say that we have more leeway to go up rather than go down. Nonetheless, I don't want to pretend that I know the future. And so any drops of Palantir from 20 all the way to 11 is just an opportunity to accumulate. These are just really how I look at the market caps. Palantir at 37 billion and AI at 5.6. Just amazing valuation for these artificial intelligence giants. You might say that C3 AI is not as competitive as Palantir, but Thomas Siebel is not a CEO to just dismiss. And C3 AI and Palantir are actually going to do very well as NVIDIA predicts AI to be in all applications in our lives. NVIDIA, of course, is a great company, but at $600 billion, it's similar to, NVIDIA is about $300 billion, $250 billion. It's going to triple as well, just like how big Alibaba is already, it's still going to grow bigger. Lots of valuations here are actually very low. So between Unity and Roblox, and especially Douyu in the gaming side, I do like the cheapest here is really Douyu. Douyu is an esports play. If you like Twitch of Amazon, you'd love Douyu. Douyu is going to merge with Huya, and therefore it's going to be a bigger. It's going to be bigger. With each Douyu share, it's going to be Huya inside. You're going to have cash dividends. You can see Douyu more like a cash dividend play. And following the sell-off of about 60%, I'd say that Douyu has fallen quite sharply, 8 all the way to 5. I haven't seen Douyu as low as $5, even during March 2020. And so I feel that it's very muted to see Douyu going down, and these levels are already too cheap to ignore. Roblox, however, could fall because it's only dropped 20%. So I'd say that Roblox could just fall another 20 to 30%. 65 could go as low as $50. So honestly, for Roblox, I'm still waiting for a 30% drop from here, from 65 all the way to $50. But for Unity, at $25 billion, I'd say that the drop is limited to about 20% lower. So 20% lower would be 88 minus 16, or about $70. I'm not sure if you can actually get it at $20 billion, but it's important to see how big the drops have been and how little the downside could be based on the upside for their gaming futures. Esports has been just growing and growing, and all the esport games, whether it's League of Legends, Wild Rift, it's all being done in Unity software. And so there's a recurring revenue being paid to Unity software for all these League of Legends, Wild Rift games, and your Fallout and whatever, actually, even your Among Us. Every game, 53% of all the mobile games is done in Unity software. That's an amazing monopoly. If you just think about it, Unity is in a monopoly zone, and at $25 billion, very cheap. Same for Douyu. Now, this is an interesting pie to understand. Very small valuations right now for the last mile delivery. People talk about last mile delivery as if it's a sure thing. I do believe in it. How could you be so bullish on e-commerce and not think about how big logistics and the last mile delivery will become? And with JD and Walmart as the partner of Dada, this is not a small company. Speaking of dividends, there's a question: what awesome 10x company is giving good dividends? I don't see a 10x company actually giving good dividends. However, like I've advertised Kellogg's, Conagra Foods, 3% yields. AT&T for HBO Max, 6% yields. For Conagra and Kellogg's, the reason why I like it, and even Nestle to a certain extent, is because of their plant-based revolution. Palantir is a bigger market cap than EI because Palantir has bigger contracts. Palantir can actually notch $2 to $3 billion in a year in terms of contracts because they work with the government. So Palantir is well known in most government contracts and actually has more clientele. So between the two, it's a no-brainer. Palantir is the number one. Okay, for the last mile delivery, Dada Nexus and Walmart and JD, these are big titans. And because they are getting a margin on each delivery, I'd say that JD Taotia, which is Dada Taotia, is really gonna grow over time. And so at current levels, already down 63%, this $22 is very appetizing. Let me give you another clue. For Dada Nexus, any price below $30, Tencent is already accumulating. So you've got actually a $600 million announced buyback on Dada Nexus. $600 million is 12% of its market cap. So when the shares are finished and bought by Tencent, I think that you'll get a huge move on the upside. So do buy. Insiders are buying Dada Nexus. What company did I buy before that had a huge insider buying? Disney at about $100 was a 5-year insider buyback. Activision at $45 was an insider buyback. I made money on that. Double my money. And then there was a huge insider buyback on SoftBank at about 5,000 yen below. So I bought that with Masayoshi's son. He felt that his shares was very undervalued, 4,000 to 5,000 yen. Yes, I agree. In fact, I feel it's 20,000 yen. So yeah, I also followed and bought with him. Another insider buyback that you should know was Farfetch at about 789. And also, I haven't seen Tencent buy more of EHang, but I should tell you that Tencent is a buyer of EHang. Tencent is an investor of EHang and Tesla when they were very young. I think that when you're looking at investments, make sure that you are buying with the smartest investors in the world. Tencent, when they're buying, I'm actually very confident that I'm right. Or if I have Alibaba at the back. Alibaba is willing to buy Xpeng. Alibaba was a backer of Xpeng when it IPO'd at $20, about 20 to 18. That's why I'm very confident that if it goes down, I have very little upside. When you think about the Howard Marks spectrum of risk, my risk is just volatility. It's not a permanent loss. That's why I'm very happy to catch falling knives. Now, for AgriFi, take note, when you think about controlled environment agriculture and the pace of cannabis, if you look at the return on investment of indoor farming solutions versus, planting marijuana in outside, if it's not a CEA, if it's not controlled environment agriculture, the likelihood is actually bad marijuana crops, bad cannabis, bad hemp extracts. So pretty sure that AgriFi will grow with the cannabis sector. And at 15, it's just $150 million. I say that with Raymond Chang at the helm, we actually have a good company here. So I like the CEO. I'm betting on the founder of AgriFi. And this one is a great value for me. While it's going down and everyone's shifting their money into boring Facebooks or whatsoever companies, okay lang. Sige. All right. So I think that AgriFi Corporation is worth your while. Nobody actually believed me before in Grow Generation when I was saying 9 to 12 was a buy. Well, what happened? It went to $50 and $60. AgriFi at $7, guys, is a buy. Even if it goes to 6 or 5. This one, you'll grow times 4 your money when you see cannabis grow. And why will cannabis grow? Kamala Harris and all the states of New York, California, Illinois, I think there's like about more than 30 states. The Biden administration is supportive of solar and cannabis. Therefore, AgriFi should be a cheaper way for the cannabis. If I had GrowGeneration before, I sold it at $50. Why? Because it's expensive. But Agrify here at 7, it's not expensive, so cheap. Another company that you may have heard about is Sundial Growers. It had an acquisition. I like a company growing and acquiring. So although it's not that cheap, if you think about it, looks can be deceiving. 71 cents is probably not as cheap as you think, but it's already 80% down. So in terms of valuation, people would argue, oh, maybe $1.5 billion is big. It's not big because the other competition is about $20 billion. And with mergers in place in Sundial, they just bought a company for $132 million to expand their distribution. This one, Agrify and Sundial, is my cannabis bet. Now, this is something that you have to be aware of. If you believe in telehealth, and I do believe in that, you are actually, the market is actually right now underpricing great companies. I saw the underpricing of the world with Google. And Google was a huge investor in a lot of, so Google was a huge investor in wearables. Google invested with Copen. And Google is an excellent investor in most everything that they do. They invested early in Waymo. They invested early in Airbnb. Google Ventures is a great company. Therefore, it makes Google actually, aka Alphabet. And so far, you did see Google go up in price. And it caught up after a while. So it's now like 2.5, 2.4, something that it should have been when Amazon was going up and Google got left behind. But today, think about it. What's a better way? Investing in Google or investing in what Google invested? I argued in about 2 years ago in a members group, Inner Circle 2019. I had very few members, but I was telling them that, hey, if Google was willing to invest in JD at $40, of course, they had a reason and a plan. You had this extreme luck to buy JD at $24 because of this rape-related scandal, which really has nothing to do with the business of JD. And so I argued a strong buy on JD. Now, of course, I did buy as well Alibaba and Pinduoduo, them being great e-commerce giants. But you could see right now that there is an undervaluation in Amwell just because it's number 2. Granted, Teladoc is better than Amwell, and both of them are falling down. But I think that with Teladoc dropping 50% and Amwell going down 70%, we are actually more in the low downside risk here rather than in the high upside. I'm happy too that, of course, Teladoc is the largest position of ARC Genomics Fund. In their healthcare sector, the reason why they invested a huge chunk, I think they bought something like $2.5 billion of Teladoc Health. If you add it all up, I'm not sure if it's $2.5 billion or if it's $3 billion, but Teladoc Health, a drop of 50%, and American Well, a drop of 70%, with healthcare sector and these two remote giants handling data, patient monitoring, the fact that Google and Amwell work hand in hand, and Google is an investor of American Well. I like both CEOs, by the way. I have a trust factor here. I'm gonna buy Teladoc and Amwell if it falls further. So I put it in my watch list. This is in my shopping list. Now, there are people who told me that Bio-Nanogenomics is better. Their Sapphire software is better, immensely 10 times better than PacBio. And with ARC Genomics actually investing in genomics space, there's going to be a lot of fund flows in genomics come next 5 to 10 years. So if you know that's just $1 billion today, of course it can fall. It can go 80% down. Assume that $5 does fall another 20%. Here at $4, these are my exotic bets that I would be more comfortable because I'm looking at the genomic space. And I do believe in what these medical professionals are saying. They know more about the product. And so Sapphire software is going to be adopted by most hospitals. And with FDA clearance, is really going to be a growth stock. So funds will enter Bio-Nanogenomics as a growth stock play. DermTech, I find it amazing seeing how they're helping a cheaper way to detect cancer, especially skin cancer, melanoma. So at just $1 billion, again, another great total addressable market, and at 60% discount, amazing. You're seeing amazing discounts right now in just 3 to 4 months. And so I argue all the bad news is likely priced in. Asensa Surgical, 72%. This is a mini ISRG, mini intuitive surgical. Senhan Systems has FDA approval, same as NanoX Imaging. The healthcare names I put here are all FDA clearance already. So all the hospitals will already use them. Same with Rewalk Robotics. Did I put it here? Oh, sorry, I haven't put it here. Let me put it here. Rewalk Robotics is also a good play. I should put it here. Wait up, Alt-IR. So there's really an amazing value. Rewalk. Rewalk is already 1.66. Wow, 6 to 1.66, down 72%. No, so it's down 7. Yeah. So I do think that these drops of 60 to 70% drops in the healthcare space is something that is an amazing bargain. And so I'm actually a happy buyer. I don't care if you have 1% or 2% or 3%. I think that these are opportunities that you don't want to miss out, no matter how deep in the red that you already are. I'm actually down 20% in some of these names, some 10% down, some 40% down, but I'm okay with it. Immersion Corp is a play also in gaming and haptics. So this is just a very small company. Take note, it is so small, it's $250 million, but it looks like a Copen to me. Just like I discovered Copen and Eman at less than $100 million, and now the market's like going up with them, touting them as growth names. Immersion Corporation is an easy derivative of Sony PlayStation 5. All the controllers are using Immersion Corporation controllers. And with their revenues all tied up with Sony PlayStation, you cannot tell me that with Sony going up to all-time highs, that Immersion Corp will be left to the dust. So at 50% down from $16 to $8 and at $250 million market cap, this is a company I'm willing to bet in. And you could see that there are Charmanders that I really want, and I don't care about the volatility. The volatility is my opportunity to buy more. Let's say it goes down to $4, no problem. What company did I invest upon that went down before? I was buying at about $7 to $10. Stellaria, which was Rubicon and became Magnite because the digital advertising was so cheap then, was buying $8 to $4. It went to $60. Immersion, I think, can go as high as $30 to $40. It's not just going to break that $16 high. It's going to go all-time highs. Give it about 3 to 5 years. Everyone in the world will know that haptics is not just for gaming. There's a lot of touch point screens. And you're going to see immersion relevant in medical breakthroughs as well. Ceragon Networks is very small, but when you consider the fact that the 5G future is dominated by Qualcomm, NVIDIA, the Snapdragons, and all these NVIDIA chips, you can't actually undermine this Israeli company. This Ceragon Networks helps. When it comes to 5G, you want Ceragon Networks, whether you understand it or not. At $270 million, it's a yes for me. So at $3 already fell 50%. Satellites and 5G, internet in space, some people don't understand it, but I think that we will need it. Somehow 5G will need to invest in these names. So Ceragon Networks, Global Star, $2 billion. Global Star is the partner of Qualcomm. I'm going to finish, don't worry. There's a question. What sector should we prioritize first when you want to accumulate aggressively? I think you can accumulate aggressively the 80% drops or the 50% drops, but it depends on the sector play that you want, because all of these companies are values to me. So I'll just give you the Excel. There's no specific right or wrong. Actually, I buy 5 stocks at a time or 10 stocks at a time, depending on how much money I can. I'll just keep on buying no matter if they fall. Yeah. So Twitter, I think, has already dropped from $80 to $50. I don't think it's going to go $20, by the way. The reason I put Twitter here and Pinterest here for my social media picks is because these small companies are growing in their different optionality, their revenue stream. For Twitter, they just added the tip jar, which is going to help all the content creators monetize. They have the Twitter Spaces, which is actually going to be similar to Clubhouse. And they already expressed efforts for Twitter Scroll. They bought already and acquired Twitter Scroll, which is similar to just a long form content, wherein all the Twitter users can actually monetize all their thoughts. So you can have a tip jar, you can have your own spaces. So I think that Twitter is becoming more revenue centric, and I'm seeing Twitter do more revenue stream apart from digital advertising. Something I like. It is a transformation phase for Jack Dorsey, and I do like how Jack Dorsey made so much money with Square, and I think that finally they're doing their act well for Twitter. So we're gonna see Twitter 2.0 in the next 10 years. And I want to be a part of that Twitter 2.0. At $42 billion for Twitter, it could go 100 billion. So I'm okay with it. It already has more than, I can't remember how many users they have, but Pinterest has 500 million. So I'm okay with both of them. 500 million users, good enough for me. I think Twitter is more than 500 million. So it's really huge. Pinterest, I like the fact that everyone who's in it is going to shop inside. So the shopping spree is going to be my play for Pinterest, and an additional advertising revenue. So ARPU, it's going to grow. So with that, at 90, can it fall to about 45? So far, Twitter and Pinterest had only fallen 35%. So it's not really a huge discount already. It's not like a screaming buy. So I'll wait. But I'm actually interested in this. I might prioritize the 70 to 80% discounts first if you're asking me what to prioritize. But I'm not actually shy to take a look at the 35% drops as well. Because it's possible that Twitter, Pinterest may never fall 50%. Might not get cut into half. So you have to also think about those possibilities. If you're so bearish, you can't actually buy it even if you wanted it. For Spotify and Roku, I like them, streaming play. I see more upside with these two companies. So far, Spotify and Roku fell 40%. 38.8% for Spotify, 40% for Roku from their highs. Now they could fall another 50%. So that means for Spotify, 387 could fall half to about $200. I'm actually willing to buy Spotify $237 to $200. So let me just show you that I don't really believe that Spotify is going to go $100. So maybe just a 15% decline. And to be honest, for Twitter, I don't see a huge decline. So just maybe 50% for these two. So when you see that, the downside is quite muted, about 20 to 30% lower. If I can actually handle a 20% drawdown, that means that I could embrace a 200 to 300% upside. I'm willing to do that. That's the reason why I'm willing to invest. 10%, 20% downside is nothing in the realm of a 10-year trajectory decade time frame. With Roku, I don't really see it going to 120. To be honest, I just think it's perhaps 200. I think for Spotify and Roku, the most bearish estimates can just drop it to 200 because households already use Roku. About from 1/4 to 1/3, I think it's now 1/2. Every 1/2 households in America are all using Roku TVs. Roku channel, and they expanded to Brazil. I see Roku doing something like what Shopify did. So they're just expanding in all countries. And so the over-the-top advertising is something that will do very well. And at $37 billion for Roku seems a great company to invest upon with a concentrated domination already with connected TV. Great secular trend. So I'm actually willing to get a lot of Spotify and Roku at $200. For Desktop Metal, honestly speaking, I'm so happy when I saw the sawdust being done into wooden materials, 3D printed houses, how Desktop Metal helps Ford, a lot of electric vehicles, how Desktop Metal helps Adidas for their 3D printed shoes, how Desktop Metal helps the braces, which is Smile Direct Club. If you just dig deep into the additive manufacturing, at about $3 billion for Desktop Metal, when it's really a clear leader to me, I find Desktop Metal the leader of the sector. And then And I like Mark Forge, by the way, but I didn't put here because the SPAC hasn't changed name yet. But when it changes name, I'll include it. So far, all the SPACs are hitting $10. Now, from a high of Desktop Metal 35, I had invested in TRNE, aka Desktop Metal, before about 10, 11. This is nothing new. If I reset and buy it at $11, it's going to be great for me because I see it as a future of about $10 billion or more. So, given that thinking, any drops of about 11 all the way to $9 is really a buy for me. Just like how Ouster fell below 10, 9, 8, it's okay with me. So I'm okay with Desktop Metal. Nano Dimension, really okay, $6 all the way to 4.5. The reason why it's $1.5 billion is because they already have $1.5 billion in cash. So I'm buying a company here that is in an acquisition mode, and great CEOs. So yeah, I do believe that they're very prudent. They're entering AI. They're entering because AI will help a lot. Deep learning is going to help a lot when it comes to manufacturing. So I see that since the future of factories is a lot of AI and a lot of 3D printed technology, cheaper. It's going to have cheaper implications for all of your material goods, whether it be just a small nail or whatever you're using, really, because it's 100. So it's true. Desktop metal is 100 times cheaper speed, 100 times speed, no? So they can produce faster speed and therefore 10 times cheaper cost. So with efficiency on the line, I do think that additive manufacturing is a bet I'm making. Now, of course, how cheap is Copen and Eman? So cheap. So I argued that I've been betting on Copen when it was like less than $100 million. That's true. When Copen was trading at $1, I was buying it. And right now at $7, it's just 670 million. Even if Copen is already working with Google Glasses, and Google Glasses 2.0 is happening this 2022 to 2023. Augmented reality is a future we'll all hold. I believe billions of devices will be sold by Apple and Google. I like a partner of Google, and so I'm a buy on Copen. For Eman, it's so low. It's just $169 million. I'm talking about millions of dollars. These are too small. So Copen and Eman, I'm always willing to bet on the wearables space. Of course, I've bet on Vuzi as well and all that. But just for simplistic state, no, they've both dropped 50 to 60% from their peak. I'd say that Copen and Eman, while it could fall, Copen, I'd allow even a drop to $3.40. You can never take me out. I'm just going to buy it all the way. And Eman, I'm just going to buy it all the way. Both of them have real clients, real contracts. Eman being a contract partner of the government, and so military government. So I think that these two are wonderful. So I'm going to share the Excel file for you. This is the Excel file. And of course, just the charts, you could see that from the chart, you could see that from February, almost all of them have dropped from February peak all the way down 60%. So this is Lemonade. So quick look on charts, 60% down on Lemonade, Nano X Imaging, 70% down, Sunrun, 60% down, AST Space Mobile, forgot to tell you, Internets in Space, I do like this, 70% down here, about $7.78. I like this pack. So I'm okay with this one. Immersion Corp, 50% drop. Baidu, 50% drop. In case you are just wanting big tech, I'd say Baidu and Alibaba will be great opportunities for you. Zoom Video at 50% drop, also a household name. Twitter, 35% drop. It could fall 50%. If it does fall 50%, maybe $40. So you might want to wait it out for these social media giant plays. Twitter and Pinterest could fall further. They're just 35% drop. So wait it out for Twitter and Pinterest, but I like them. C3AI has already fallen 70% down. You might be actually undermining this company, and this is actually worth a shot. American Well also being undermined, 70% down already from 42 to about $13 with Google as a partner, and with a very highly skilled CEO, the French doctor. I really like how they've been growing over the past 12 months. The reason I think why these fell was just people thinking that, well, COVID vaccine, all these problems are over. I don't want to do online consultation, which I believe is wrong. Everyone, when they had the taste of telehealth, they'd want it forever. And so American Well and Teladoc is going to have a great 10-year history. I want to enter while everyone is exiting as if there's fire in the building. Saraga Networks, 50% down, could fall further, but it's also very cheap in the realm of 5G. Copen, so cheap in terms of market cap, based on their total addressable market. Copen also has a stake in Nreal, which is already being sold in Korea. That is Nreal is and also some Samsung products. Copen is actually one of the most undervalued. I'd still say it, even today, still the most undervalued. Undervalued in the year 2020, still undervalued in 2021, even after $1 went to $7. Eman, yes, Eman is still undervalued. You saw it $150 million. I believe that all the wearables are already partnered with some giants. And so when you have the patent and the technology, you will win. These are really solid fundamental picks, guys. So I honestly don't care whether it's a falling knife. And when people tell you to go away, it's a falling knife, it's a falling knife. That's the reason why we did an Excel file and why we do our due diligence for our fundamental picks. You can just buy it even if you're down 20% already in it. Yatsen, yes, I like this. I don't care if you bought it at 12, at 9 or 8, doesn't matter. As I see this company, take a look at their quarterly reports. They're actually growing. So I don't see a reason to actually evade the direct-to-consumer level business. Agrify, this is really cheap. If you believe in cannabis, you would buy Agrify. Agrify's clients are all cannabis operators. If you're a cannabis operator, you want indoor farming, this is a company that people are, robots and algorithms are programmed technically. And when they see a new low, they'll just sell it new lows after new lows after new lows. They have no care about fundamentals, which means that this knife in Agrify is an opportunity. Whether you bought it at 9 or 10, 11, I think now that it's at 7, it's really a screaming buy. I might say that this is really screaming a buy to me right now. Agrify at $7, yes. The $7 bets is Agrify and Copen, even if it goes $5. Sundial here is also a buy for me, whether it goes 60 cents. Teladoc is a blue chip. If you want a blue chip that's dropped 50%, Teladoc Health is for you. Fastly is this is not a blue chip yet, but I don't believe that we will actually forgo Fastly. So a drop of 70 to 80% is a godsend. If Fastly drops about $30, thank you. Thank you for those shares. It's going to be back in May 2020. You have to dig deep on the earnings report of Fastly. The market is actually exaggerating, and they are wrong in exaggeration. Joshua Bixby is going to deliver the results in the next 6 months. Give them time, they will. Peloton, I think John Foley is an underestimated CEO. The Tread Plus is really just one death. I'm not undermining the deaths and the injuries, the refunds, but remember, they can handle it. This was just an ancillary product. So there is a huge core base of Peloton bikes, and they can continue growing. Any drops is really a godsend, whether it drops $70 or $40. I know that there will be shorters at 99. This is what you call a typical head and shoulders move. 170, 120, it could fall. So first fall is $70, and then further fall is 40. I think that you want to actually see the action on Peloton before going in. But this one I'll watch. Doyu is already dropped. That's why this is also a $7, $8 name that I will buy. I'm pretty sure of the cash dividends of Doyu because they already reported that they would merge with Huya this June. So in terms of near-term catalyst, Doyu Huya is an esports bet and growing and already concentrated majority in China. Sorry, yeah. So in China, in esports, it's only Huya, Doyu, and Bilibili. So this is really like a triopoly in esports. So there's no way out. It's just gonna go up in time. So it's a cyclical move right now. You could see that 8 went to 16, made some money here. Any drops of 7 will not kick me out. 8 all the way to 7, I'll just buy it. Desktop Metal, as I said, I'm impressed. So down 70%, buy. Affirm, yes, the Peloton is just a drop, but this is a reopening play in my view. This drop from 140, let's say it goes to 45 or 50 is an opportunity. So my quick buys tonight would be Agrify, Affirm, Doyu. Yes, I'll be buying these names. because I think that these 80% drops are already quite substantial. Yeah, they are just $7, $50. Yeah, these are great names for me. Okay, Eman and Kopentu. Dada is also in the insider buying side. So you want to buy this. Just as I did an insider buying movement before when I saw Activision, massive insider buying at 45. And that's what I'm seeing with Dada Nexus. Great partners, a lot of insider buying. 21 to 24 is actually more of a buy more. Array Technologies, I just think solar is really undermined. It might not bottom yet. Solar is solar. I think there are so many people who are probably just leveraged in solar. I don't see a point of dropping like a bottomless pit, but I just believe in the secular trend. So Array, Xpeng, Reset, these are good values to me. Unity is not necessarily cheap, but at $25 billion could go $20 billion further, could get a 20% drop. But I'm okay with this name. So this is not an immediate buy, but if it falls further, I am willing to buy. Yeah, so I believe in this one. Agora, yes, Agora at $40 is okay, but maybe I can get it at 35 billion. At $35. We'll see. American Battery Metals is cheap. So at 120, I'm willing to bet on this name. Spotify, already a household name. 40% drop is good enough for me. Roku, if it falls 200, so Spotify and Roku at 200 is really a value play for me. Arcimoto, yes, this is a buy. 75% drop already. Nano Dimension, also a buy. So yeah, I hope that I gave you a lot of ideas today. And oh, sorry, I forgot. Oh my God, I've been talking and talking. I thought that you guys were seeing the charts. So sorry about that. Yeah. I'll be uploading the presentation for everyone. For the people asking about the Tilray, it's not my go-to for cannabis. I'd prefer a more predictable way. And I don't want, so I like to play pick and shovels. When I played cannabis before, I played it through Grow Generation, because Grow Generation was supplying to all the cannabis operators, to those who are planting. So that's why I prefer Agrify. I don't like a direct bet, because when it comes to cannabis, you could buy it from Afria, you could buy it from Kronos, from CGC, Canopy Growth. You've got a lot of competition. So I'd like to buy the maker of the planting. So that could be the indoor farmers. So that's why I'd rather go for Agrify when it's a cannabis bet. If there are no questions, thank you for everything. Yes, Facebook Oculus Quest is coming out. So more wearables. Actually, I think they already sold 200 million devices, or is it like, I have to review my numbers, but yes. If you'll notice, the big tech is all in with wearables. Microsoft HoloLens, Facebook Oculus Quest, Sony has a lot of wearable games. All of the games right now has improved. That's why Tobii eye tracking is doing so well. It's doing all-time highs. That's in Sweden. So if you just believe in the secular trends, guys, I think that Christmas came early this May. In order for you to make 3x, 4x returns in the next 3 years, I don't know how long it may take, you have to invest your cash. Don't wait for about another drop. Remember what Howard Marks said. You want to invest when people are upset. You don't want to invest when everyone is happy and cheering and when it's popular. You want to invest when it's not really popular. Thank you very much. Bye-bye.